Hello all. We are going to do chapter 10 today, making capital investments decisions. This is we are following chapter 9, where we learned net present value and internal rate of return. In this chapter, you learn how to apply them into real cases, and what are some of the things we need to watch out and the nuances involved in applying net present value and IRR into real projects. Okay. The first thing we want to know, and I'm just going to put down my small computer down so you'll be seeing the ceiling. Actually, I'll just switch that off. And so we will learn that we can apply the net present value techniques to a number of different kinds of projects. So for example, if you're starting a new business, manufacturing a product, or even if you're going to, expand your own business, existing business, anything that involves outlaying a certain amount of investments. Others include providing or expanding a new service. Let's say you want to start a service business. At the manufacturing level, or even at your office level, if you want to replace an equipment and you're considering different kinds of equipments to install, then you need to know net present value. And you can even go into cost items. For example, if you're just trying to say which is the best computer system to get, there are ways to analyze it using the net present value method. The basic format of a net present value analysis is simple. We need to know how much investment we are going to have to make, and then what are the expected benefits from that. Usually they are positive cash flows, but sometimes it could just be, there could be no revenues, but just minimization of cost. Let's start with a simple example. We're going to invest $100,000 in year 0 to purchase an equipment to manufacture, let's say, ceramic vases. And we expect to receive cash inflows of $34,400 for the next 5 years. Now, how does that look? Well, it looks like this. If you draw a timeline, that will be minus 100,000, and then you'll see the 34,400, right? So these cash flows, by the way, we need to define a little bit more. They actually represent the actual amount of money that we will have in our checking account at the end of the year. So the way you want to look at this is when we do cash flow analysis in finance, we put up 100,000 cash up front, because it could be credit, but the idea is it's outlaid. And then in return, it's the net amount that's in our checking account. So it's not the net income, as we'll show you, but it's the net cash flows that come in. To highlight that, let's go and do a hypothetical example here in the next screen. Let's say with the ceramic waste business, we are trying to figure out how much money we'll have at the end of the year, okay? In this example, we're not going to include fixed costs or our interest payments. Let's say our sales revenue is $100,000. And our variable costs associated with this revenue is $56,000. It includes, everything, the material we buy, the wages we pay, so everything that goes into a cost of goods sold, for example. Now, with $100,000, we also need to deduct the money for the equipment that we bought. So obviously we're going to not use the full 100,000, but we'll say it's going to last for 5 years. Then we are going to portion one portion of it. And let's say if you use straight line depreciation, then it'll just be 20,000, right? Now in the real world, we have to use MACRS, and that's those percentages are provided by the IRS. There are guidelines that tell us. But in this class, we're always going to use straight line depreciation. So let's just say the cost is 20,000. We apportion for that equipment that we purchased at the beginning of the year. That leaves us with the earnings before taxes of 24,000. Let's say the taxes is 40%. So that will take out 9,600, and we'll have a net income of 14,400. Now, but remember, as I said earlier, we want to know what's the actual amount that's left over in the checking account. So that 20,000 we deducted, we didn't pay it actually this year. We paid it last year when we paid the full 100,000, correct? So in terms, that's only for tax purposes where we are deducting that amount. So we add the 20,000 back, and that's our cash inflows. So in finance, we have to be very careful that that's what we use. So we should make sure that we get 34,000. So now we know we're going to get 34,400. Now this is a basic generic formula for cash flows. Okay, this is what we'll use for it. But in the real world, you may have other costs and other kinds of revenues coming in. But the basic, the main formula is as is shown over there. Now for our analysis, we don't have to actually write it down this way. We can also do it as an equation. So for example, we can say the same thing can be written as follows. That is the cash flow, or the cash inflow is revenue minus variable costs minus depreciation, take away the taxes and add the D. We're using R for revenue, but you can also use S if it's, technically it's sales revenue. So some will use S minus VC, but that's just a minor point here. So if we were to use our numbers, same numbers that way, we'd do 100,000 revenue minus the variable cost, minus the depreciation, take away the taxes, add back the depreciation, and get 34,400. Now let's try and do the net present value. So based on our chapter that we did, we will use the cash flow buttons. And let me just refresh everybody's mind. So we'll put, for CFO, we'll put the minus 100,000 as our cash flow. For C01, we'll put 34,400. When it says how many, we'll say 5. Then we'll click on NPV. This is the BA2 plus calculator. IO, we'll say 15. Enter a return and compute, and it will give us 15,314. So what it means is we will definitely make our 15%, but in addition, we'll have extra money left over in year 5, whose present value is going to be 15,344. So we'll obviously accept this project because NPV is greater than 0. If we were to use the IRR criteria, then we'd click on IRR compute, and we'll get 21.30%. And since we use 15%, we'll assume that's the minimum the company or the investor wants. It's obviously greater than 15%. And we'll, of course, go ahead and use this project. Okay. Now, before we go into more examples, there's a couple of issues we need to discuss as it relates to the application of the various inputs in coming to reach the cash flows. That includes both how much money we have to dish out and how much money is coming in, okay? Now, first thing we have to remember is that, listen, in finance, we are really interested in the real numbers, the relevant cash flows as we call. How much money do you actually have to dish out? And how much money is actually coming in. Now, sometimes some of these projects would be incremental projects. In other words, you already have an existing business and you want to make a change. You want to maybe buy a better equipment. In that case, there's a slight change in the formula, but it's nothing major. It's basically saying, okay, in that case, talk everything in incremental terms. So how much money will you put out for this, let's say, new equipment that you plan to buy? And then tell me how much my sales will increase by. So it's the net change in cash flows that we are looking for. Okay, so how much more will I make if I do buy this new equipment, or if I do hire this new group of people? Exactly. So the only thing that changes, we add a delta to it. So many times I don't even bother to add it. It's just assume you can use it for new projects or for incremental projects. But basically means the increase in cash flow is going to be the increase in revenue minus the increase in variable costs, increase in depreciation, add back. And so I'll get an idea of how much additional money I will have. So the difference between new projects and, let's say, replacement projects or enhancement projects is that you see how much more money will you dish out, how much more money you will get in. Now, things to consider when we're estimating these incremental cash flows. In finance, one of the things we like to be obsessed about, including economics, is that, you know, every project should be based on a standalone principle. That is, the key thing to understand is when you evaluate a project, you should accept a project when it is standing alone on its own merits, that there is no subsidy involved, that there's no cheap financing made available to you by a grandmother. It should stand on its own. Like, if anybody takes that project, is that project profitable and gives a positive net present value? Okay. Now, as we'll find out, this is nice and easy to say, but in the real world, there'll be all kinds of other reasons why you may take a project or you may not take a project, and those will generally fall into strategic reasons. There often can be cases where you may have to accept a project when it's even not profitable, and there are cases when you'll have to reject projects when it is profitable. Let's start with one. This has no strategic implications in here, but there are issues that we need to discuss, and it is called sunk costs. And there are many times when we are trying to evaluate a project that we have to put in certain money to even determine its feasibility. Let's say a company wants to decide, or is planning to expand into another market. So they hire a marketing firm. The study finds that, you know what, if you do spend that $1 million, you will, it is a net present value greater than or equal to project, and you should undertake it. However, let's say the marketing cost is $200,000. If I include the marketing costs, then my net present value is less than zero. So the question comes in is, should we accept the project? The answer 99% of the time is that yes, you should accept the project. The marketing cost is a sub-cost. You've already spent that, you're not going to recover that money under any circumstances. So based on that, for the most part, sunk costs are gone. So one thing to remember is not to include sunk costs into project evaluations at this point. So let's take another concept that's important when determining cash flows. It's called opportunity costs. So an example of this kind is something like this, that let's say there's a company that plans to build a plant, and it has a huge amount of land in its existing facility. So if it builds the plant in there, then the net present value is greater than zero. But if you had built the plant outside, or even assumed a value, a market value for the land within that company, then the net present value is zero. So in other words, this project is profitable only because you're getting a subsidized land. So the question is, should you undertake this project? And it's the same principle here. On a standalone basis, it obviously doesn't meet the test. What you're saying is that, hey, it's only because of the cheap land that it's profitable, not when you include the cost of land. So the answer for that is, unless there are strategic reasons, you should not accept the project. Based on its risk and based on the full cost of the project, it's not acceptable. However, marketing department or other departments could argue and come back and say, if we don't have this plant and produce this, competition might eat into our other products, we may lose in the long run, et cetera, then if there are some strategic reasons, that's the only time you will accept it. But strictly speaking, from an economic point of view, all costs should be included, including the cost of the free land. And if it says no, then you should not accept it at that point. Okay? Here's an interesting one. It's called side effects. Let's say, for example, you have a very successful business in Hempstead. Let's make it a pizza place. So you did the analysis, greater than 0, you open it up, and it's doing very well. Next, you decide, I'm going to expand. I'm going to expand it into Uniondale. So you find a place, you locate a spot, you do the analysis, you have to spend $200,000 renting, furbishing, getting initial working capital, etc., and NPV is greater than 0. But there's a catch. The catch is that when you take this, you'll take customers from your Hempstead restaurant, and this thing will end up in a loss. So should you take this project? It's termed side effects. Well, different books have different definitions, but this one says side effects. So this is tricky, right? Because on a standalone basis, it's saying yes, but then your own other plant is going to go down. So again, now it'll become strategic. One argument you could make is if I don't open up, somebody else opens up, and then we'll lose sales in Hempstead anyway. Then of course you should say, go ahead and do that. But if you're reasonably certain that there is no competition coming in, then obviously you'll say, maybe not, I will just go and do it elsewhere, so I don't hurt my Hempstead business. So such strategic considerations will always come into play. For example, companies like General Mills and Procter & Gamble, which keep coming out with different kinds of, cereals or washing products, etc., are constantly cannibalizing on their own other brands. But that's part of their strategy because they cannot stand still. Other competition will come in and take them if they don't come up with new products, even if it means cannibalizing their own other brands at this point. Okay, now final thing is net working capital. Now, net working capital is something we have to include because anytime you start a business, there's the part where you have to buy the main equipment, etc., but then there's the other part which makes up with your treasury function, which is the day-to-day running of your operations, right? So, for example, for the most part, by the way, net working capital is defined as the current assets minus current liability. So what are current assets? Current assets are usually made up of cash. And let's say this is cash as your checking account in your bank. Now, mostly let's say you have an existing business and you normally maintain a $10,000 checking account balance. If you start a new business, there's a good chance you'll have to increase that to 20,000 because you need the cash constantly to write checks, etc. like that. Marketable securities, not so much, but accounts receivable, definitely. You'll have to give more credit, and therefore your credit balance will go up. And the same thing is inventory. Now, before I move further, let me just do a quick note on accounts receivable. I know you did it in your accounting class, but let me refresh your memory what it means, right? What does accounts receivables show you when you look and see 200,000, 400,000 in my accounts receivable? Well, basically, it means on average, someone owes you money at a given point of time. But that means you have to make an investment for that. So let me start with a simple example. Suppose you're starting a new business and the opening day, you try to sell your goods. Let's say it's a pizza place. And you find out that nobody is coming to buy pizzas from you. So it turns out that maybe if you give credit, you'll be able to sell pizza. So let's say on the first day, you offer 3-day credit payment terms for payment. That is, they can pay after 3 days. And lo and presto, your daily credit sales now goes up to by $1,000. So on average then, at the end of the day, someone or one of your clients will owe you $1,000. So this is day one. Let's see what happens in day two. Same story. You sell only because you give credit, 3 days. So at the end of the day two, you have $2,000 owed to you. Along comes day three, same story, $3,000. Now along comes day four. Now it's become a habit. Everybody's expecting you to give you credit sales. You make another 1,000. How much do you, some people owe you on average? It'll still be 3,000. Why? Because this person will pay the 1,000 back at that point. So in day five will be the same story. This person will pay the minus 1,000. So on average, then someone will owe you $3,000. If we are doing the formula, it will say average accounts receivable is equal to daily credit sales. Okay, this is daily. Times, there's various terms used for it, but let's call it average collection period. So it'll be 1,000 times 3 days for collection, so it's $3,000. Now let's say competition increases and you find out your competitors are giving 5 days. What's going to happen to your average collection or your accounts receivable? Obviously now it will change because you will end up 5,000, and then on the 6th day your payment will come in. Day 6 minus 1,000 plus 1,000, so 5,000. So in that case, it'll become 1,000 times 5 days of credit, so $5,000. So what we are saying is, in order to start the business, therefore, you better make sure you have money to support your accounts receivable, because since you're going to give them on credit, you'll have to come out with cash. And the same story holds with inventory. You have to start piling inventory. So you better make sure you have enough money to purchase, get the inventory going and piling up, because otherwise, you could run out of inventory and you don't want that. So you put in extra money to do that. So it's an investment in that respect. Now, your current assets, therefore, will go up, and you have to make sure you have enough money for that. But on the other side, on the accounts payable side, is the other way around. You could reduce your current net working capital because suppliers will give you some money. So, for example, that 1,000 that you're buying all your working capital stuff could be given, your supplier could give you the loan. So if the supplier gives you even 3 days, let's say, credit for everything that you purchased to make the pizza, for example, then you don't need any working capital because everything is on credit. You're giving credit of 3 days, they're giving credit to 3 days, and if everybody pays on time, you won't need any money. Accrued wages and taxes, there's nothing you can do in the sense that this is what you have to pay your employees, so you'll be accruing wages at some point. But that's benefit to you because you don't have to pay it every day, you'll pay every 15 days. And notes payable is bank loans, and that's exactly what you'll do when you run short of the money. So the good news about working capital, however, so let's say there's a project. It's a 5-year project, and your equipment costs $100,000. Then let's say you have to spend $20,000 you want to keep aside for working capital to increase your receivables, put more, can make sure there's more money in your checking account, etc. This we depreciate over the time, but this 20,000 gets recovered in the end. So when you close shop, if you have given credit to clients, it will eventually come back to you. If you have built extra inventory, it'll come back to you. Okay? So the only difference between this and the regular investment at the beginning of the period is that this investment is recoverable at the end of the project. So that's the main example. So two other things we want to do is that in this chapter, we're going to, in this chapter and in this class, we're going to ignore debt payments when estimating the cash flow. That's important because when we evaluate a project, as you know, debt is, the interest on debt is tax deductible, so you can have some benefit. But we don't have to include that in our allowance. We'll later teach you on how to include it as a separate variable, so that when you evaluate projects, you're evaluating purely from a business perspective. Is this business good? Above and after that, you can say, should I finance it with equity or should I finance it with debt? Because I know debt is cheaper, but that's a different story. We'll add that later on and say, well, you get further benefits if you add debt. And finally, as I said, we'll be using the MACRS schedule for estimation of depreciation. Okay, so and remember in this chapter, oh wait, I made a mistake that. In the real world we use MACRS, but in this chapter and in this class, we're only going to use straight line depreciation at this point. So next we're going to do an example, and what I'm going to do is I'm going to stop here and stop this, and you'll have to go into section 2 in order to continue. So I'm going to stop recording.